It may be that they're coming into a DST because they either want to diversify, or perhaps they're seeing opportunities to exit a market that's either frothy or wrought with legal challenges or legislative challenges, as we've seen a lot in California. But they allow the investor to become more passive, to perhaps be better diversified, and to often they'll even have liquidity provisions on exit that are very attractive to the investors.
Hi, this is Kris German. Welcome back to the Apartment Dealer Show. Do we have a treat for you today? We have with us Mr. Warren Thomas of JRW Investments. Now, Warren has been on our show before. That video was highly watched, and it has to do with all things DSTs. And this is part of our interview series as we prepare for our Apartment Owners Educational Luncheon, 15th Annual Apartment Owners Educational Luncheon at this time. We will be speaking with each of those individuals involved to give you a sense of who they are, their background, the specialty that they speak to, so that you know what to anticipate when you're with us at the live event. Now, Warren and I sat down a few years ago for nearly a 1-hour interview where we go through the ABCs 1, 2, 3s of investing in DSTs. We're going to link to that video here because we won't necessarily be covering those topics once again. I wanted this conversation to build on that initial conversation. So I would say first, if you haven't watched that video, watch that video on YouTube, and then that'll give you the good primer you'll need as we dig into our conversation today. So Mr. Thomas, thank you for being back with us. Welcome.
Thank you, Kris. Glad to be back.
Now, for those who may not be familiar with Warren Thomas and your work, maybe just a quick background. How did you get involved in the world of DSTs? A little bit about JRW.
Yeah, my background. I'm getting a little bit older now, so my background started quite a few years ago. I was a CPA by profession, Masters of Taxation, and in the 90s began working with my firm, which I had founded in the 80s. Bringing financial planning services to investors. And we developed a specialty in the real estate arena. And by the early 2000s, we had developed into one of the largest due diligence shops in the country, reviewing 1031 exchange programs that were being brought to the broader investors.
Yes.
Back in those days, we called them ticks, and then the IRS had some changes in 2004, and we began to use this acronym of a DST. And so, yes, I've been involved in the business for quite a number of years in the DST business.
Just a small refresher primer. What is a DST?
Yes, a DST is a Delaware Statutory Trust, and it is technically it's what we call a grantor trust, much like if you and your spouse have a living trust, that is a form of a grantor trust. And the IRS is allowing for investors to purchase, to come together and purchase larger investment properties under this DST or Delaware Statutory Trust structure. And they don't call it a corporation. They don't call it a partnership. It actually qualifies to where an investor can come with a sale of their rental property, and they can choose to put those rental proceeds into a Delaware Statutory Trust, or they might choose to go into 5 Delaware Statutory Trusts to give themselves diversification. And Delaware Statutory Trusts have been used for almost any type of investment real estate, from multifamily properties to industrial to office to net lease properties, and some esoteric types of properties that are not as commonly used. But they're a great way to consider diversifying from your original rental property into a portfolio, if you will, of properties where you can become more passive, not actively engaged in the management. And some people will even refer to some of them as almost little mutual funds of real estate.
And so who is a DST really cut out for, or who makes a good candidate to invest in a DST? I know that my friend and who's spoken at our events before, Bruce Norris, he helps people buy rentals, say in Florida. And before he'll let them spend a dime, he actually interviews them to kind of sense out what kind of investor they are, risk tolerance, and these sort of things, management habits, to really assess, is it a good fit for them? I imagine with a DST, with the type of vehicle that it is, the length of the hold and what have you, it's more ideal for some investors than others. What would you say to that?
Yeah. We usually say that the DST market is really built for the retiree or pre-retiree. Those that they've probably made a lot of their wealth in real estate, whether they are the fireman or policeman that, has been working their real estate on the weekends. Of course, the weekends always turn into the weeknights as well. But, or whether it's the full-time real estate professional that owns 20 or 30 units or 250 units. It's really that person that is ready to get out of the active management and to become more passive. So in our programs, and I'll also add, Kris, I'm also a principal of one of the largest DST providers in the country. So JRW Investments is where we started with the DST market, but we expanded to where we get involved in actually the production of specific DSTs. But our investors are often in their 60s or 70s or 80s, and it may be that they're coming into a DST because they either want to diversify, or perhaps they're seeing opportunities to exit a market that's either frothy or wrought with legal challenges or legislative challenges, as we've seen a lot in California. But they allow the investor to become more passive, to perhaps be better diversified, and to often they'll even have liquidity provisions on exit that are very attractive to the investors.
And so if an investor, I'm hearing this for the first time, and I say, this sounds interesting, let me go on Google DST companies, a myriad of options come up. As the investor, as the consumer, how does one decipher one DST company from another? What should the investor be looking for?
Yeah, they're depending again on your stage in life. I just mentioned that most of the DSTs are actually being built for that pre-retiree or retiree. And so they typically are going to have modest debt. And by that, I'll say debt in the 52% leverage on down to zero. When I produce DSTs, I'm typically going to be in the 40%. So they're made for an investor that isn't looking for high leverage and trying to take that small amount of equity and multiply it quickly. The DST is more for the investor that wants that stability. They don't want as much risk as they might have wanted 30 years earlier in their career. And so the DST market recognizes that. And so I'd say to your question, some investors, it's just the wrong asset type. No matter what's in the DST might be too conservative. A DST, the IRS has put some rules around them. And one of the rules is that you actually cannot, in that structure, go back in and refi. And, a lot of your advice is going towards investors that have bought property, that use leverage, and their intent is to grow rents and to refi and cash out some of that equity. A DST doesn't allow that. And the IRS, I think, is wise in that they're saying, hey, we want investors at this stage to be able to do tax-free 1031 exchanges, but it's a different stage, and they're not looking for to give investors that ability to refi and take cash out. So there's some restrictions on DSTs where they're not appropriate for everybody, but they might be quite appropriate to that retiree.
If I hear you clearly, then it's almost a preemptive move to completely retire from the real estate game, in the sense that, many of our investors, they've held property for a length of time. And if it wasn't because of capital gains tax, they would have sold long ago. But because of, for many of them, that means 40, 50% of taxes, they continue to hold, gritting their teeth. You mentioned the legislation. That's especially the last couple of years.
Yeah.
Before that, it was rent control. Before that, you can add a number of things. So they just continue to manage to deal with this issue of the capital gains. But the DST will allow these individuals to sell what, multifamily is the most it takes the most time in terms of management versus office or warehouse. And essentially be totally hands-off in a DST, receive monthly income, management's done for them, and it'll give them a hold probably somewhere between 5 to 10 years, typically is what I see. And then from there, they can decide, okay, do they do, say, maybe another 1031 exchange into another DST if they like the relationship and so forth, they like just the monthly income, or maybe at that point, since 10 years have passed, maybe now is the time to exit and pay those gains or what have you. So it sounds like it's the preemptive move to, as you're trying to remove yourself from the equation and you're looking for just more lifestyle but steady cash flow.
That's right. And some DSTs would add to what you just mentioned. So there'll be a hold period, and DST hold periods can be anywhere from maybe even as short as 3 years up to as long as 10. There aren't too many that go beyond 10. And then on exit, the DSTs, you can always do a 1031 to go back out of them. And you go do a 1031 back into another rental property, back into another DST, or there's also the TIC structure, the tenant in common structure you could go into. So you can cash out, you can do another 1031, and many of them you can actually go into their REIT under what we call Code Section 721, and you actually contribute the properties from the DST. They go right into a REIT, and that REIT might be $1 billion or $5 billion, and then so the theoretical risk mitigation that comes with the law of large numbers, you could basically go into something that has hundreds and hundreds of properties. And again, that concept of a mutual fund of properties and de-risking. So there are some great exit options available in the DST market. From the standpoint of how do you know a good DST from a bad DST? Everybody's got their preference. They think, well, we know rental property, and so we might want to stay in multifamily. Well, multifamily is a very popular vehicle to go into in a DST, but you also might want to go into net lease with investment grade companies, because these are Kroger's and Walmart's and Walgreens, and they always pay or theoretically always pay their rent, right? And they might do extremely well during a COVID environment because they're necessity driven. So that's another area where you might not want to buy, one Walgreens or one CVS, but you can go into a portfolio of them under a DST and get those benefits. Some investors, it's kind of interesting with long-term real estate investors, many of your clients and my clients have been real estate agents or brokers in their career at some point. I mean, a lot of them come out of the real estate arena. And I have a number of examples where I've had someone come to me and say, oh, I've got these, 20 or 30 rental properties. And I'm now at a stage where I want to get out of the management of all of those rental properties. And so they start coming and we go, okay, here's $250,000 in equity in this one. The next one's $320,000. The next one's $170,000. And they start repositioning using these DSTs, and they can go into multiple DSTs over the 3 or 5 years or 2 years if they're trying to divest themselves of that rental property challenge. And so they can get into a lot of different DSTs that have different goals, different asset mixes, but they're all passive, and they basically are graduating themselves into the retirement years. And that's always fun, but that's happened so many times where I've had investors come that have been professional realtors turned rental property owners, and they're just going through this process of diversifying out of that workload that they've been engaged in for years.
As the viewers sit here, I imagine, skeptical as, many investors, multifamily owners, they're analyticals, right? So they're trying to pick it apart. So they say, well, hold on. You're telling me that I can just invest my money. You're going to do the management for me. And there's no risk, given, especially today in light of the climate of the economy, recession, inflation. And so I'll start here, and then we can build on it. But interest rates. So if they get analytical enough, they say, well, hold on, the cap rate and the interest rate. Maybe if you can dive in for us, what impact interest rates have, say, on a DST that's being held over 10 years, and you got in at an initial cap rate, and over the course of that hold, interest rates are ticking upwards like we've had the last couple of years.
Yeah. So in a DST, with the different types of DSTs, interest rate's going to impact everybody. Cap rate's going to impact everybody. And you might be of the school of thought that says, okay, hey, I want to go into multifamily again. I'm going to sell my rental. I'm going to go into multifamily. And I'm going to do that because I believe that inflation is going to be here. And because of that, I think, even if it's a DST, they're going to drive rents with inflation. And that's my philosophy. If you're going to go into multifamily, then is there risk, or is it just a nice inflation ride? Well, the problem with assuming it's a nice inflation ride is that a couple different things. One is, guess what happens when you get into inflation? If inflation is accompanied by recession, which is often the case, then you've also got vacancies and concessions that are going up in that multifamily property, to say nothing of taxes, insurance, your maintenance costs, your utilities, all of these operating expenses. Yeah, they go up when inflation hits. So multifamily is not immune, even though you theoretically have an inflation hedge. Now, if I'm going to stay with multi for just a second. So you come into multi, you probably want to make sure, if you're looking at DST, that you're buying something that has just been purchased recently, and you're not buying into a stale DST that was bought last June. Because some of the DSTs, if they may not have sold, they might still have equity, and somebody's presenting you with a DST where they bought the property in June, July, May, and they've still got 10 million, 5 million, or some sort of equity, and so you're being presented that asset. Well, the cap rates on every real estate type have been going up. I buy a lot of net lease property. Well, the cap rate on my net lease, even 8 months ago, was about 50 basis points lower than it is today. Now, what does that mean? I'm buying property today at a lower price than I was buying 8 months ago, 6 months ago, a year ago. Okay? So from a purchase price standpoint, if you're buying today, you're buying at today's higher cap rate, which means lower price. Okay, but you're going to find, no matter what the asset type, I would disagree with the theory that, you come into a DST and there's no risk in it. There is risk. There's economic risk, and the interest rate risk can pretty much be taken care of by going into deals, programs that have fixed interest rate. And that's one thing I think has improved a great deal in this DST market over the last 10 years, is the use of a lot of fixed debt instead of variable debt. So we're not seeing many DSTs at all that have had a problem because interest rates have gone up with a variable debt. Most of the older ones were locking in 10-year debt. So if you came into a DST 2, 3, 4 years ago, 5 years ago, 6 years ago, you're probably still in this 10-year fixed debt, and the debt might have been a 3.3, 3.7%. Today, that debt is now going to be costing 5.5%. Maybe 5.5%, maybe 5.75%, maybe 6%. And so that cap rate may not have kept up with the cap rate increase or lowering of the purchase price. may not have kept up with the increase in the interest rate for new programs. So we're seeing less debt used on new programs because the debt's more expensive. And we're seeing shorter debt terms. Instead of 10-year debt, we're seeing more use of 5 or 7-year debt because we don't want to see investors locked into a higher debt cost for 10 years. Now, even with that, you're making assumptions that over the next 5 years, 7 years, debt costs are going to come down and be a time to be able to get out of the property. But even that is a risk, right? So there's always risk. I appreciate that, Kris. There's always risk in these deals, and you just need to understand it and see whether that risk profile fits your profile. And if it does, it'd be appropriate. If it doesn't, and you just have to make sure you understand the underwriting, and don't work with a novice. If you're working with an advisor, work with somebody that knows what they're looking at.
You brought up the fact that across asset classes, cap rates have been going up. I would argue that the main pressure there is interest rates and just the perception of the market of what the rise in interest rates means to the overall market. And you have a very interesting vantage point. The vast majority of the viewers of this show own multifamily properties here local. When I say local, probably Los Angeles, San Bernardino, Orange, Riverside counties. Vast majority. Then the next segment behind them are individuals who own multifamily but more abroad. And then a small segment that maybe own, the other various asset classes. Now, because your company not only purchases, medical, office, industrial, and so forth, but also you're purchasing properties across the nation, what would you have to say about the current state of the real estate market? And if you had to guess, say, in the next 12, 18 months, what is going to play out in the market overall?
Wow, that's a great question. So I'll first go to the rental property across the country. We see big differences in different markets as to where those markets are landing. We're seeing in that whole San Francisco market, it's come down already, by a third in price. Your $1.5 million properties going for $1 million. And that's on average, right? Mm-hmm. So you find a rental property owner, you never like to think you're selling when your price is down. Mm-hmm. So it changes that market. You may see more people holding on. We're not seeing as many sellers up there because they rode the wave up in price. And so they've got this value up there, and now it's come back down, and it's come back down to where the market was in 2019. So the long-term rental property owner hasn't lost anything, but they might not be as quick to sell because they want to see it go back to $1.5 million. Well, that's occurred there. Kris, you know the LA market and the Orange County market really well, but we see similar transitions, and then even the LA market and Orange County market, different patches in those markets respond so much differently. Mm-hmm. The Inland Empire is not like Pasadena. And right. I'm in the middle of the property I bought 4 years ago, and we're just getting ready to flip it. And yeah, do I wish I was, sold it a year ago? Yeah, probably. Right. But the Pasadena market's been a pretty good market to stay mm-hmm. in, and so it hasn't been fluctuating like some other areas. When you get into the broader United States, many areas in the United States have stayed extremely stable, and we still get the calls from the Minnesota landlord or the North Carolina landlord where there's been no drop, depending on what market they're in. So all the markets are not behaving the same, and you can look at the blue state, red state phenomena, right, and who's friendly to taxation, and you have a much stronger market in those places that are friendly to taxation.
I think that, and see what your thoughts are here, Warren, that the uptick that we saw in values starting with COVID, interestingly enough, that this virus could have caused this uptick in values. So now you see a significant change in the opposite direction. But it's because, when you're at the tip top of the roller coaster, of course, that initial drop is going to be more severe. You're not, at the extended part of it. And that has a lot to do with, like you mentioned, a third in San Francisco. I read the articles that watch multifamily throughout the state, but I didn't realize that you've seen, drops that steep. How much of it would you attest to it's because the market was overinflated, this weird blip on the screen from COVID, versus, hey, you know what? If you look further back, this is the natural cycle playing out that should have played out, but COVID stepped in right in the middle of the real estate cycle.
COVID just meant we were already in a easy money cycle, right? We've been in an easy money cycle for years now. And then COVID accelerated that and made money easier still. So I don't think of it so much as COVID phenomena. I think we've just been in this easy money phenomena, and we can't stay there. So the Fed's trying to break that down now, and they're tightening up, bringing back in the money supply. And so as that continues to get tighter, it's going to just be more expensive money. Now, I also don't think that the government can afford to allow interest rates to go where they probably need to go. They need to go higher, okay? Because we can't get out of this inflation without really seeing inflation rate, interest rates go higher. However, the government cannot afford to have interest rates remain high. So I do think that real estate's going to be benefiting from the government's problems and not being able to stay away from easing money supply in the long run. So it's a really interesting time. I don't think, Kris, that this time is exactly like other times. I do believe in cycles. I've lived through more than you have, but we've gone through a bunch of cycles, and we're going to see more. But I think this one is still a little bit different. And I would be, I'm not afraid to be a buyer of real estate. I think real estate is going to be protecting from inflation, but and I do think we're going to have opportunity to be coming in, to be obtaining loans on our real estate, because the government's going to be under pressure, is going to have to keep interest rates somewhat modest.
And it's funny how many people I ask, and essentially that's their response, is that even though we know better that rates should go higher, unfortunately it just can't, that's just not going to be the case. And so horrible for the nation, but great for landlords, in terms of this conundrum that we're in the middle of in terms of economically, right?
Yeah.
Now, our educational event that you'll be a part of is all about giving investors the inside information that they need that'll hold them over typically for about another 12 months, but it's all under the guise of educating the landlords so that they feel like maybe going into the event, they're anxious, having, I don't care which news channel you watch, it's all bad news, right? And so they're anxious going into the room, if you will, but when they leave, they feel relieved, like, hey, you know what? Although things may not be ideal between the information you'll share and everyone else, I feel like, okay, I've got a firm grasp on reality and not all the negative news that's out there. So, information. My last question for you here. And because you've been an investor, you've been doing this for so long, decades of experience, multiple cycles, CPA, I would ask you, what do you see as the number one mistake investors make when investing in real estate?
What is the number one mistake that investors make? There's more than one.
Sure.
But probably one that hits home is losing control of your real estate when you're unable to do the job that needs to be done with it. For most everybody that'll be in the room, they are owning individual pieces of real estate, and we've seen too many people where it's often the husband that's that's really working the real estate, and they stick with their real estate beyond their ability to do a good job with it. And a good job might be anything from maintaining the property to losing the ability to negotiate their rents, often because of not being aware of what the market really is. They used to know, but they're not paying attention as well anymore. That could also be of choice, but under performance on a piece of real estate will immediately, chop its value down. And so that could be not keeping up on rents, not keeping up on the property, not keeping up on the laws around the property. It's really underperformance on that real estate, which is self-inflicted.
Thank you, Warren. Thank you for your time and your insights. We look forward to you being with us for the first time and what you have to share. It really is a unique experience in the sense that you have these various individuals who are all, I would argue, pinnacles within their each individual areas of expertise, to then bring all the speakers up for our Q&A with the landlords, where then they get to pose a question, but not just get the answer from, say, one specific industry, but from all the various individuals that sit on the panel, because it might be a multifaceted answer, and it truly is just a great opportunity. For the landlords, I can't tell you how many of our clients who have been doing this a long time that say, gosh, I wish something like this would have existed when I first got into business. It would have been so helpful, so I wouldn't have, fell into so many traps and what have you. And so I thank you again for being open to join us at our event. Warren, if the viewers have questions for you, want to get in touch with one of your advisors, what's the best way to do so?
Probably you could use my email, wthomas@jrw.com. So wthomas@jrw.com. And I also welcome your phone calls, even to my cell phone, which is 626-644-7033. And if I don't recognize the phone call coming in, leave a message so that I know how to screen it, and I'll call you back.
Well, you're a courageous man putting your cell phone on YouTube. I'll tell you that. I'm yet to do that. But thank you, Warren. Thank you again for your time, and we look forward to being with you soon.
Okay, thank you.
I hope you found today's interview informative. DSTs, is this something that you should look at? Are you one of those individuals that Warren hinted at, that, you know what, you're on the last leg of your investment life, if you will, and it's time to look for a different strategy? Maybe you're one of those investors where in your heart of hearts, you know that it's time, that to avoid that number one mistake in real estate of owning too long beyond your abilities. That might take some humility to be able to admit that, and I understand. But the idea here is, what is it? We are building a financial legacy in multifamily properties. No need to have built up a huge, profitable legacy only for things to go sideways, right? So DST might be a good exit strategy for you. Now, for those of you watching who own in our area of service, the time is now to register. We've already had about a third of the seats taken just from one invite that's gone out for our live event. So if you own in our areas of service, which you would have been invited, typically by direct mail, that's a good way to know, a direct mail piece invite to you, the time is now to register. You do not want to miss out. Between Steven Spear, real estate attorney extraordinaire, Mike Brennan, eviction attorney specialist, Gil Figueroa, commercial lender for more than 3 decades, Dave Barrett, that can tell you all there is to know about cost segregation, Warren Thomas, who will dive into what is a DST, how to invest in a DST, tips and traps of owning DSTs, and myself to give you a market overview. What is happening on the ground? Not what we're reading in real estate journals, but what's really happening on the ground in terms of prices, rental rates, vacancy, sales volume, buyer philosophy, seller optimism, pessimism. What's the reality of the market? That's all going to be discussed in a short, brief afternoon, and we serve a free lunch not to be missed. So we look forward to having you. If you haven't already, be sure to subscribe to our channel. Turn on the alerts by ringing that bell down below so that you receive all our upcoming videos. I promise you, the information that's going to be shared over the course of this year is going to be very meaningful to you as a multifamily investor. And with that, Kris German from the Apartment Dealer wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.